July 13th. 80 targets struck overnight. The Strait blockaded. Oil up 9% in a day. Stocks fell less than 1. Markets are supposed to fear war. This one fears something else. To understand what, follow one golden coin. Act 1. The machine that eats everything. Four giants will pour roughly $785 billion into AI data centers this year, more than America spends building all transportation. By one count, this build-out supplied 3/4 of last quarter's growth. Strip it out, the economy was nearly flat. Economists dispute the math. Nobody disputes the scale. That's why war bounces off. In June, one chipmaker's soft forecast erased $1.3 trillion in 2 days. The war never came close. War reaches stocks through a side door. Oil, then inflation at 4%. Then a coin flip chance rates go up this month, not through fear. Act 2. Follow the coin. The world's biggest chipmaker invests $30 billion in its biggest customer, the lab behind the famous chatbot. Watch the marked coin. The lab promises the cloud builder $300 billion for computing it needs. Computing stuffed, of course, with the chipmaker's chips. The builder borrows over $120 billion. Cash flow, deep red. Credit rating, one notch above junk. Tenant list, mostly the lab. And the money lands where it started, the chipmaker's record revenue. Its customer's own finance chief admitted most of it goes back. It isn't one circle. The Everything Store invests $50 billion in the lab, while selling it cloud. A Japanese fund borrowed $40 billion to invest. Below decks, middlemen borrow billions against the chips themselves, some near 14%, and the chipmaker guarantees to buy capacity nobody rents. The lab has promised roughly $1.4 trillion in computing, against $13 billion of revenue. Even the chipmaker's chief said they don't have the money yet. Act 3. We've seen this loop before. 2000. Equipment giants lent customers $25 billion to buy their own gear. The customers died within a year. The lenders followed. -99, -98, -89, while revenue kept growing. The fiber got used, eventually, by owners who paid pennies. Now the differences, and they're real. Today's buyers are the most profitable companies in history, $450 billion a year in cash. The chipmaker trades below the market's own multiple. Cisco peaked near 10 times that. Demand is real, sold out, and the cash cushions are thinning by design. So, why does the market refuse to crash? Because the loop is the index. 7 companies are a third of it. Every automatic paycheck dollar buys the machine, including yours. And the crowd agrees. Dip buying ran 3.5 times normal this year, with leveraged funds at record size. Conviction or reflex. A market that ignores a war isn't calm, it's positioned, and positions can change faster than facts. Hold both truths. What would tell you? Autumn spending guidance, the builder's next borrowing, the lab's stock listing, and how fast these chips really age. Numbers dated July 14th. Inflation and bank earnings land this week. This has been the Meme Economy. Education, not financial advice. Subscribe.